Hey, you're welcome. We have been waiting for you. Finally, we have sufficient numbers in class. So I guess others will join us as we proceed in the class. So today we want to start with another milestone for our class. After this topic, what we have left will majorly be ratios, EPS, and sustainability reporting. So no big deals for us and few other things. But those are the major things we have left after group account. So I welcome you all to this class. And before I proceed the class, is there anybody in this class that has zero knowledge of group account? So if you have zero knowledge of group accounts, you can signify by raising up your hand using that hand raise icon. Just want to I just need I need this feedback for something. Okay, good. So that means everyone here in this class has an idea of group accounts. You have one way or the other done it before. Okay, good. So let's start our class then. So just confirm that you can hear me. I just need somebody to make a sound to be sure.
I can hear you, sir.
Hello, sir.
Okay,
Hello,
great.
sir.
Hello, Michael. Okay. So you're welcome again. Today, we'll start group accounts. But the way I'm going to start is for us to understand why group account. It's for us to understand the context behind why we would have to be learning this. And for that reason, I'll start with what we'll call intercorporate investment. So the reason why we are learning group accounts is because of intercorporate investment, and from this phrase, it means one entity investing in another or one individual investing in another. And when one entity invests in another, it creates a lot of dynamics. But before we go to those dynamics, why do entities invest in one another? Like you would have companies like Google acquiring a lot of startups. You have companies like Facebook acquiring series of startups. And our very own Paystack, they were recently acquired, not recently, it's been almost 3 to 4 years ago. They were acquired by a US company. And you would have a lot of companies making investments in one another. So why intercorporate investment? For a variety of reasons. Some is just for strategic control and influence. Like Otedola, for example, acquiring equity interest in First Bank is majorly because he wants strategic control. He wants to be the chairman of the board. He wants to have or influence, either of the two, strategic control and influence. Okay, I'm back. So strategic control and influence. Some others buy investment in another entity just basically because of financial returns, probably to earn dividend or to earn interest, majorly for that reason. That's why some people would invest. Some people is because they have surplus funds, so they just want to put it somewhere, just to invest, not for any particular motive in mind, but just to invest surplus funds. While some people, they want to balance their their portfolio. So they consciously want to diversify their portfolio just so that there is balanced several among several industries. That's why some people would invest in another entity. Some is for the purpose of tax planning. Some will purposely invest in another entity that they see that the country where that entity is resident is tax friendly and investment friendly. They will go all out to invest in such an entity just for tax planning and management. And the list can go on and on and on. Different reasons why entity invest in another company. Now, when they invest, so intercorporate investments are done through financial instruments, that is, equity instruments or debt instruments. This is the instrument with which you would invest. When you want to invest in another company, you are either going to be buying any of these two. Either you're buying their debts or you're buying their shares. So equity or debt. So today, our focus in group accounts, our focus in group accounts is where the investor invests through equity instruments, invest through equity. So that's the focus of what we want to look at. That okay, when you invest through equity instruments, what does it result into? So we are not going to be focusing on debt because I've already taught you debt instruments under IFRS 9 and IAS 32 on how to account for that. And I've taught you a little of equity. So we're going to expand and end all the learnings you need to know about equity instrument under group account. So we're going to be focusing on group account. You see, where an entity invests through equity instruments, see, it can result in these types of investments. So, number one is it can result in investment in subsidiary. Number two, it can result in investment in associates. And number three, it can simply be financial assets. Or let me also add investments in joint ventures. So your equity investment, when you invest through equity by buying shares in another company, it can result in any of this. And you're expected to know all of this before you go for that exam. From here, I've only taught you where your investment is financial assets. When you buy shares and it gives you financial asset. So we're going to do the introduction of these other ones as we go ahead. So So majorly, before I pick on each of these, right? So to account for investments, to account for the above types of investments, we'll use the following accounting standards or the following IFRS. First, we are going to learn about, in fact, everything we're going to be learning is majorly around IFRS 10 that deals with consolidated financial statements, and also IFRS 3 that looks at business combination, as well as also look at IFRS 11 that looks at joint interests or joint ventures. Also, we're going to look at IAS 27 that looks at separate financial, IAS 27 that looks at separate financial statements. Also, we're going to look at IAS 28 that looks at investment in associates and joint ventures. Investment in associate and joint ventures. So majorly, this will be our focus to learn these types of investments. Now, first is investment in subsidiary. So when you buy equity interest, and that your equity interest results in investment in subsidiary, how does this happen? So this type of investment occurs where an entity acquires, or let me call this entity an investor. When an investor acquires equity interest in an investee and its holding in the investee is above 50%. So this is what we call investment in subsidiary. You see, this type of investment gives the investor a control over the investee. However, know that an investor can have control over an investee without having over 50% holding in the equity interest of the investee. So this is what mentioning that first, you would have an investment in subsidiary where an investor acquires equity interest in an investee and its holding in its investee is above 50%. I said that this type of investment gives the investor control. And now, I now mentioned that, yes, it gives him control when you have over 50%, but I said that it's also possible that you can have control without 50% holding. Again, like Otedola, the one that we are familiar with in Nigeria, acquiring First Bank, he doesn't have 50% ownership, but he has control. He's the chairman of the board now. How does that happen and all of that? We need to really look at it. So from here now, the key thing, the key element in investment in subsidiary, therefore, is control. So as soon as you have control, then that other entity, that investment is an investment in subsidiary. So what does control then means? Okay. So an investor has control over an investee where the investor has exposure to, or has rights over the variable return of the investee through its or from its involvement with the investee, and has the power to affect, not has the, and has the ability to affect those returns through its power over the investee. So when we say control, because control is what gives rise to investment in subsidiary. When you have control over an investee where you have exposure to, or has rights over the variable return of the investee from its involvement with the investee. Involvement will have been that you invested, right? And has the ability to affect those returns through its power over the investee. You see, from this definition that I gave you, there are three things that stands out. Number one is exposure or rights. Exposure or rights over the variable return of the investee from your involvement with the investee. Number two is power over the investee. Number three is ability to use the power to affect the returns of the investee. You see, all of these revolves around the fact that, number one, variable returns is the money made by the investee from whatever source. You have right, when you say you have right or exposure over it, meaning you're going to be sharing in that return. But that is not enough. Just having exposure or rights to returns is not enough, does not mean you have control. Because everybody that's invested in that company will have exposure or right over the returns. But going to control means that you have power over the investee. And you have to be able to use the power to affect. You see, when you can decide how that return is distributed, is shared, now we are talking. That is control. So it's sequential, no? Right? Number one is, okay, you have exposure. Everybody has that, in as much as you're an investor. But by the time you're not having power, and you can use that power to affect the return, you have control. So that's three elements of control, right? Now, I need to mention that, you see, in this definition of control, what stands out is power. It's power, because that's what shows control in these three elements above. So when you say an entity or an investor has power, What does it mean? You see, this is an existing right. Yeah, an existing right that gives the investor the current ability to direct the relevant activities of the investee. That's power. Existing rights that gives the investor the current ability to direct the relevant activities of the investee. So, two things here, right? Number one is existing rights. What is this right? What are these rights? Number two is that those rights is what gives you the ability to direct the activities of the investee, to direct it. So, what are these rights that give such an ability? You see, these existing rights, arises either let me pluralize this. This existing right arises either directly through acquisition of shares of equity interest that gives the investor voting power over the investee. You see, this right in question can be either because you have bought shares in the investee, and this shares now gives you the ability to vote. Voting power. No, let me call it voting power. That's repeat. Let me call it voting rights over the investee. Right? And also, this existing right can also arise indirectly through any of the following. Number one, the investor, number one, the right to appoint, remove, or reassign the key management personnel of the investee. Number two, the right to appoint, remove, or reassign an entity that directs the relevant activities of the investee. Number three, the right to direct or veto the investee to enter into transactions in the favor of the investor. And finally, other rights are stated in a management contract. Okay, so even if you don't have equity interest that is up to 50%, but you can demonstrate any of the following. In fact, that gives the investor voting rights of above 50%. In fact, no, that gives the investor majority voting rights. Let me put it that way. It already covers this first one. So if you don't have majority voting right because of your holding, but you can demonstrate any of the following, that is also power. You can remove the key people in the company. You can appoint the key people in the company. You can reassign them. That's power. You have power over the investee. Or you can do same thing to an entity that directs the relevant activities of the entity. That's power. That's power. Or you can direct or veto the investee to enter into transactions in your favor. And that's power. You have power over that investee or any other right as stated in my bank contract. So that is majorly an investment in subsidiary. So the key thing, what signifies investment in subsidiary is control. And what gives control is power. What gives power is when you have majority voting rights or when you can demonstrate any of the following. So you see, where an investor has an investment in subsidiary, the investor is known as a parent entity, while the investee is known as a subsidiary entity. So when you have investment in subsidiary, you become a parent to that entity, while the entity becomes your subsidiary. Now, the second introduction is investment in associates. So this type of investment arise when an investor acquires equity interests in an investee and its holding in the investee is between 20% and less than 50%. This type of investment gives the investor significant influence over the investee. Note that the investors holding in the investee does not have to be between 20% and less than 50% to have significant influence over the investing. So it does not necessarily follow, but yes, that's what signifies it. But this investment gives significant influence over the investing, but it's not just about that holding alone. It's other factors, right? So the key thing here again is significant influence. And this is the power. This is the power to participate in the financial an operating policy decision of an investee. So when you can participate in the financial and operating policy decision of an investee, then you have significant influence over that investee. And this power to participate arises, this power to participate arises either directly through ownership of voting rights of between 20% and less than 50% in the investee, through indirectly through any of the following. Number one is ability to participate in financial and operating policy decision. Number two is representation on the board of directors. Number three is provision of essential technical information. Number three is interchange of managerial personnel. And number five is material transactions between the investor and the investee. So even if your holding is not in this range, but less than it, but you can demonstrate any of the following, that shows that you have significant influence. Either you are represented on the board, you're the one providing technical information to them, or you exchange managerial personnel, or you enter into material transactions that are material with the entity, or you participate in policy decision, either financial or operational, then these are indicators that you have significant influence over the investee. So where an investor has an investment in associates, the investee is known as associates. So it becomes an associate to the parent entity. Now, how do you then account for investment in subsidiary? So let me try and see if I can sort out investment in subsidiary. Then we can revise investment in associates. Then probably go to investment in joint ventures. So how do you account for investment in subsidiary? You see, IFRS 10 requires that an investor that has an investment in subsidiary to prepare a consolidated financial statement. So when you have an investment in subsidiary, you are required to prepare a consolidated financial statement. And this financial statement is the individual statement of the parent and the subsidiary that is prepared as that of a single economic entity. So prepare it as if you are preparing that of so it looks as if the financial statement is for one entity that is not for more than one entity. Whereas is actually the individual statement of the parent and the subsidiaries that is prepared as if is for one economic entity. Now, before I show you the technique or the procedure used to prepare this financial statement of the parent and the subsidiary as part of a single entity, let me mention some key things that needs to be noted before a parent can prepare a consolidated financial statement. Number one is exemption from consolidated financial statement. So IFRS 10 allows the parent from preparing consolidated financial statements if any of the following exists. Number one is that the parent is itself a wholly owned subsidiary. So you agree with me that it makes sense for him not to prepare consolidated financial statement because he himself is a subsidiary of another company. Then that means that's his own owner, who is now his own parent. That means the guy is going to prepare for everybody. So he doesn't have to prepare anymore since he is also a subsidiary. Or it is a partially owned subsidiary. So whether it's wholly owned or it's partially owned, but there is somebody that is a parent that has control over him that can prepare financial statements. And of course, and if it's partially owned, okay, and it's other owners, that means there are some minority or non-controlling interests, and it's other owners who otherwise are not even entitled to votes, does not object, they don't object to the parent or to the entity not preparing consolidated financial statement. So they don't object to him not preparing. Okay, even though we are minority, since your own owner is preparing, the main person is preparing, no, well, I will use that as a basis to make decisions, to get all the information we need and all of that. And number two is that also the parent is not a listed entity. So if you are not listed on the stock markets, you are not required. You are exempted if you wish to You're exempted from consolidated financial statement. If you're not a listed company, don't start doing group accounts. Nobody's or preparing consolidated financial statements. No one is enforcing that on you. Or it's securities or its equity instrument is not in the process of being listed. These securities are not even in the process of being listed on the market. And also, its ultimate parent entity will prepare consolidated financial statements in line with IFRS. So these are exemption from consolidated financial statements. So if you can demonstrate this, it doesn't have to prepare consolidated financial statements. It doesn't have to. Another one is potential voting rights. So before you consolidate, so the parent needs to consider the effect of potential voting rights, BVRs, potential voting rights, to determine whether it still has control. So you would consider the effect, and potential voting rights are instruments like debts that can convert to equity in the future, or when you have share options. Maybe they have given out share-based payments to their staffs or to a supplier. You need to consider that, okay, if they become shares, equity, will I still have control? You need to consider the effect today and let it reflect in your decision. Because if you will not have control again, don't even prepare consolidated financial statement. So you consider the effect of potential voting rights today, even when they are not voting rights yet. You consider the effect to make your decision on whether you have control or not. Another one is exclusion of a subsidiary. Exclusion of a subsidiary from consolidated financial statements. So a parent entity must consolidate all its subsidiaries unless it has lost control over a subsidiary. So you can't just exclude if you have many subsidiaries, of course, which is the focus of this class, where a parent has many subsidiaries. When there are more than one subsidiary, that's the focus of this class, not when there is one subsidiary. No, we won't spend time on that. So it is expected that the parents must consolidate all the subsidiaries. Don't exclude anyone unless you have lost control over the subsidiary. So this requirement is necessary because there are some entity that will not want to consolidate a subsidiary on the grounds that probably maybe it is a loss-making subsidiary, or probably maybe they are using it for a tax haven or some other shady transactions. So they might want to exclude such a subsidiary from their report. Now, this standard is saying, no, that is not allowed. You have to consolidate all your subsidiary unless your control is no longer existential, is not existing anymore. That is when you can then exclude a subsidiary from consolidated financial statement. Another one is uniform accounting policies. So all the members of the group, the parent and its subsidiaries must have the same accounting policy before consolidated financial statements can be prepared. If there are variances, the subsidiary are required to update their accounting policies to the parent's policy, to the parent. So it's not the parent that will change his own accounting policy for subsidiary. It's the subsidiary that will change his own accounting policy to the parent. That's what will happen. It's subsidiary that will change his accounting policy from the parent. So again, somebody said I should explain this exclusion again. So exclusion, you cannot exclude a subsidiary from the consolidated financial statement unless you have lost control of that subsidiary. It's only where control is lost that you can exclude a subsidiary. Otherwise, do not exclude. Finally, on this aspect is uniform reporting dates. So, reporting date means year end. So again, the parent and its subsidiaries must have the same reporting date before consolidated financial statement can be prepared. Their reporting date has to be the same. So if the parent reporting date is December, we expect the parent reporting date to also be December. They need to have the same and similar reporting dates. However, if this is not feasible, if they cannot have the same reporting dates, the parent can still proceed with consolidation if the differences in reporting dates is not above 3 months. So if the difference in reporting date is not over 3 months, then yes, it can still consolidate. However, the subsidiary must make adjustments for significant transactions within or between those dates. So if the date of the parent is, let's say, December, and that of the subsidiary is, let's say, March, so they can still consolidate. Of course, the date will be that of the parent, December. But between that December and March, we need to adjust for only significant transactions. So how do you determine significant transaction? The standard didn't really mention is about judgment, but significant transaction in that wise is that we want the position of the group to be that of the parent. So we want to only reflect what is happening at the date of the parent. So any transactions that happen after that date to the subsidiary that are indicative of what was existing as at that date, as at the reporting date of the subsidiary, you adjust for it. For example, let's say during in February now, let's say one of the customer of the subsidiary goes bankrupt. He went bankrupt. So that means somebody don't just go bankrupt. It must have been ongoing. So that means as at December, I just write off that trade receivables. So significant transactions is really talking about adjusting events that occur after that parent reporting date. So we'll find a way to make adjustments for those significant transactions. Now, how do you then consolidate? So don't forget that we're looking at investment in subsidiary, where the parent will be required to prepare consolidated financial statements. So how does it do it? Recall that we mentioned that consolidated financial statement is the financial statement of the parent and the subsidiary that is prepared as that of a single entity, prepared as if is for one entity. So how do we achieve this fit? So see, first is that this consolidated financial statement is prepared using what we call the consolidation method. Of course, this name does not really influence everything. So, and this method involves that number one, you have to cancel out similar transactions that appear in the books of the parent as an asset and in the books of the subsidiary as either equity or liabilities. And second one is you then combine or add together the remaining uncancelled items. And that is how that's what we want to do majorly. That's how we want to consolidate the statements, the consolidated statements. So we'll look out for similar transactions that appear in the books of the parent as an asset and in the books of the subsidiary as an equity or liability. Let me write and vice versa, and vice versa. So if it appears in the book of the parent subsidiary as an asset and the parent as equity and liability, you cancel it out, then combine or add together the remaining uncancelled items. That's basically what I want to do. You see, examples of these similar items are, let me give you two examples. Number one is the investments in the books, the investment in subsidiary that appear in the books of the parents should be cancelled out against the equity of the equity in the books of the subsidiary. That's one example that is being cancelled out. When the parents invest in a subsidiary, in his own books, in his own separate account, he will have recorded that investment at the amount he bought it. He will put it in his own books. Subsidiary, of course, that investment that the parents made is represented by maybe equity in the books of the subsidiary. When you want to consolidate, you will cancel those two out because they are similar items. They are similar transactions. So repeating them is like repetition. So that's not consolidation. You cancel them out. Number two is intragroup transactions, intragroup trading. Let me not put intragroup. Let me be specific. Trade receivables in the books of the parents arising from trading with the subsidiary should be cancelled out against trade payables in the books of the subsidiary. So basically this are what we usually cancel out when it comes to consolidation. And as soon as you do all this cancellation, whatever is remaining, you would usually then combine all of those together. And also is that any profit arising from trading between the parents and the subsidiary must be cancelled out. Any profits or income, let me even say or income arising from trading between the two of them, they are similar transaction, cancel them out. So majorly, for those of you that have done skills and all of that, this was the emphasis of that level. And here at this level is not different, just that at this level, we want to look at much more subsidiaries. So we're not focusing on a single subsidiary, but more than one subsidiary. So before we solve questions, then I'll just show you some sample questions within 20 minutes. We'll not take too much of our time so that we can go to our own focus, our own attention for this class. Is that, you see, beyond preparing consolidation, a parent must also prepare his own account. So we should not shy away or forget that. So there is parent separate financial statement. So because, don't say because I should be have prepared consolidation I've prepared consolidated financial statements. That does not preclude you from preparing your own separate financial statement. So, so, so the parent is still required, to prepare its separate financial statements. And in this financial statement, the investment in subsidiary, the investment, that money he paid to buy those shares in the subsidiary, okay, would be recognized in its separate financial statements, either at cost or in line with IFRS 9, maybe at fair value, whatever, but majorly at the amount you bought it. So, and this is a requirement of IS 27. It's a requirement of IS 27 that, okay, you still have to prepare your own financial statement separate. See, however, however, if the parent applies the exemption from preparing, consolidated financial statements. Remember I told you that a parent can be exempted. So if he applies that exemption, so it must make the following disclosures. So he must disclose the following. Number one is that the fact that its financial statement is a separate financial statement, and it has applied the exemption from preparing consolidated financial statements. So it needs to specifically state that, okay, this financial statement I'm preparing is my own financial statement too. And I'm doing that because I applied the exemption. I opted not to prepare consolidated financials. It has to be very clear on that. Also, it needs to also disclose the name and country of incorporation of the parent entity that prepares consolidated financial statements. I told you that since he can apply the exemption if he himself is a wholly owned subsidiary. So he needs to tell us, okay, so which company is now preparing the consolidated financial statement? He needs to tell us the name of the company, the country of the company of that entity, and the address that the consolidated financial statements can be obtained. So the address at which we can obtain it, you need to tell us. You have to seriously tell us that as well. Furthermore, you need to then tell us the list of significant investments in subsidiary, associates, and joint ventures. You need to tell us all the investments you have, your list of significant investments, and the name and country of incorporation of those investors. Also, you need to do a description of how those investments are accounted for. How are you accounting for it? So all of these things, I'm taking my time to write out for you. I mean, you really need to know them. They can ask it in the exam. The examiner requires that you'd have a good knowledge of them. So when you have a consolidated financial statement, you see that it will comprise of the following. Number one, you find the parent separate financial statements. Parent separate financial statements. In the consolidated financial statements, you find it there. Also, you will find the consolidated statement of financial position. You find it there. You also find the consolidated statement of profit or loss and other comprehensive income. Also, you find the consolidated statement of cash flows. Also, you find the consolidated statement of changes in equity. And finally, notes to the financial statements, including summary of significant accounting policies. Okay, so this is the theoretical background for consolidation. So let's quickly look through some questions for today. So for today, wherever we get to on these questions, I will just allow you. Then next week, we'll start when you have many subsidiaries. I will just allow you to use this one to practice land. And next week, we'll start when you have many subsidiaries straight on. So let's start with this question. Do I have IFOA in the class today?
Yes.
Okay, please read for us.
Okay. Illustration 1. Alpha Limited owns 40% of the voting shares of Beta Limited. The remaining 60% is widely held by other passive investors, none of whom owns more than 5%. Alpha Limited also holds a call option to purchase an additional 30% of Beta Limited's voting shares. The call option is exercised at any time, is deeply in the money, and expires in 3 months. Beta Limited's key decisions are made by simple majority votes. Alpha Limited is also entitled to appoint 3 out of 5 board members. 1. Does Alpha have power over Beta? 2. Are the potential voting rights substantive? 3. Does Alpha have exposure to variable returns? 4. Can Alpha use power to affect returns?
Okay, thank you very much. So, does Alpha have power over Beta? So he owns only 40%. If I want to judge from this, judging from just voting right of above 50%, I can say no. But when I looked further,
Yes.
again, I saw that It says 60% widely held over investors. So if I judge by these two, it doesn't have power. But when I then read on, I saw that this same company, no, it has a call option, meaning it has a potential voting right of additional 30%. And remember, I said when you want to determine whether an entity has control, you need to consider the effect of potential voting rights. So automatically, he has he has power, so which can then lead to control. However, looking at just power alone is just sufficient. This 40% to a large extent is just sufficient to say yes, he has power. Because somebody that has 20% self can have power because that's significant influence. And significant influence is a power to participate. So, yes, I can just jump into conclusion and say, okay, this guy has power. So he has power over the investee because its voting rights is 40%. And there is even a PVR, a potential voting right of additional what? Additional 30. So he definitely has power. Are the potential voting rights substantive? Are the potential voting rights substantive? Meaning that is it going to crystallize or is it going to convert it to shares? That's what they mean by substantive. Is it something that will become shares? Yes, it is substantive, or they are, let me polarize it, they are substantive because they are said to be deeply in the money. Deeply in the money means that it's attractive to convert, which means that it is attractive to convert to equity or ordinary shares. So that's deep in the money, meaning they would benefit if they convert. Does he have exposure to variable return? Oh, yes. Oh, yes, because he has ownership interest. So he will be entitled to dividends and all of that because the entity has ownership interest in the investee. He has ownership interest. Can he affect those returns? Yes. Yes. Because it's total holding, including the PVR, potential voting right, is over 50%. So if not for this PVR, I would say no, it cannot affect. Because affecting those returns that's control. But because it has PVR, potential voting right, and is deeply in the money, which means that it's very attractive um um to extend, is very attractive to convert, then yes, it has it can affect those returns. So let's go to illustration 2. Afua, please.
Okay. Lesson 2. Zeta Group is a public interest entity preparing consolidated financial statements under IFRS. It owns 100% of the equity shares in Omega Limited, a wholly owned subsidiary incorporated in a foreign country. Omega Limited has been placed under long-term government receivership due to regulatory violations. The government appointed administrator has full control over financial and operational policies. Zeta Group has no access to financial information under with financial information, cannot appoint board members, and is legally prohibited from directing the entity's activities. The receivership is expected to last indefinitely, and Zeta Group no longer receives any returns from Omega Limited. Based on the above facts and IFRS 10, should Zeta Group consolidate Omega Limited on its consolidated financial statements? Justify your response.
I'm sure everybody here knows the answer. I'm sure every one of you knows. So, no, it cannot consolidate the Zeta Group or Omega. It cannot consolidate Omega Limited because it does not have control. It does not have control over the entity. And why does it not have control? Look at it now. They appointed an administrator, is the one that has control over the operational everything. This, it does not have access to information, and it will continue indefinitely. It doesn't even receive any return. It doesn't have, it's not exposed to variable return, so it cannot consolidate. So this one is very straightforward. So it's just for you to see that control is beyond having ownership interest or equity. Is more of the power to make some decisions, to affect returns, right to returns, and all of that. That's what gives control. And it's only when you have control that you can prepare consolidated financial statement. Okay. Illustration 3.
Okay. Illustration 3. Alpha PLC has a 100% owned subsidiary, Beta Limited. Alpha's reporting date is 31st December, but Beta prepared its financial statements to 30 September due to local regulatory requirements. The financial statements of Beta are not adjusted to the group's reporting dates. Can Alpha PLC consolidate Beta Limited without adjusting for the difference in reporting dates? What are the requirements under IFRS 10?
So for this one, you see that the difference in reporting dates is 3 months. So yes, it can consolidate. Yes. Alpha can consolidate Beta Limited because the difference in reporting dates is not over 3 months. However, adjustments must be made for significant transactions. So we need to ensure that it makes adjustment for significant transactions. Otherwise, it won't be able to go ahead with the consolidation. It won't be able to. Illustration 4.
Illustration 4. Beta Group owns 80% of Epsilon Limited, which uses the revaluation model for property, plant, and equipment, while Delta uses the cost model. Epsilon's financial statements are prepared using its local GAAP, which has not been aligned with IFRS. Can Delta Group consolidate Epsilon Limited without adjusting Epsilon accounting policies? What does IFRS 10 requires in this situation?
Thank you. So epsilon cannot consolidate, or delta group cannot consolidate Epsilon Limited without adjusting Epsilon's accounting policies. So it needs to update Epsilon's accounting policy to its own policies. Furthermore, since the financial statements of Epsilon are prepared using the local GAAP, this also needs to be prepared using the IFRS. So the individual accounts of the parent and the subsidiary must be prepared using the same accounting regulation. Okay, so that's just like a revision on all those things I mentioned. Okay, let's go ahead. Please, before I read this, please.
Okay. Pico acquired 100% of the equity of SCO since incorporation of SCO on 31st December 2017. The statements of financial position of the two companies on 31st December 2017 are given below. Statement of financial position as at 31st December 2017. Please scroll up. Required. Prepare the consolidated statement of financial position of PCO at 31st December 2017.
Okay, so I'll just give you a guide on this, just to show you that principle of consolidation. I won't start preparing it for you guys here until when I get to when we have more than one subsidiaries, and that's when we'll spend a lot of our time not on this. I just want to use this as a quick revision for you. Again, for this one, to consolidate here, I said cancel out similar items. So let me just hear from you. Here now, if I may ask you, which items are we going to cancel out here? Is there anybody that can tell me which items are we going to cancel out here between the parent and the subsidiary?
Investment in
Sir, can I try, sir?
Yes.
Yeah, it has to be the retained earnings. Then ordinary share capital of both parents and subsidiaries.
Okay. So you said you cancel out this with the equity of the subsidiaries because they are similar transactions. So the question was very specific. So we invested in ESCO. So this 60,000 was what the parent recorded in his books. And what he will have bought is the equity of the subsidiary, or what we call net assets, fair value of the net asset of the subsidiary. So the equity of the subsidiary, not even, yes, yeah, fair value of the net asset, which is asset minus liabilities, it will equal equity. So this 60,000, we simply cancel out against this 60,000. So you are correct, Michael, if that's what you said. So every other one, you can add them together. Add these two together, add this together. So that means when you get here, you only present this 100,000. Why? Because this 40,000 will have been cancelled out. When you get to share premium, you will only have 125,000 because this 20,000 will have been cancelled out. Again, here we don't have any retained earnings for the subsidiary. Then this one, you add it together. So that's what we mean by cancellation. That's what we mean by cancellation. Now let's try the second one. So if you look at this one, Pico regularly sells goods to its subsidiaries ESCO, which is its own season corporation. The statement of financial position of the two companies on 31st December 2017 are given below. Okay, so they give us statements and all that. So we are now required to prepare consolidated statement of financial position. Okay, so what do we cancel out here? Who can try this one? What are the similar items here?
We cancel out the receivables
Inventory.
for PSO, the one that is related to SCO. Then the payables for SCO that is related to PCO.
Okay, that's correct. That's absolutely correct. So you said that we're going to cancel out these receivables because writing ESCO means that he's expecting money from ESCO. So it's the same. And when you check payables now, this and it's the same 1,000. So this one also said, okay, he has 1,000 that is expecting from Pico. So cancel them out. Cancel it out because they are the same thing. So you're correct, Jacob. So cancel that 1,000 against that 1,000. Any other one?
Sir,
Investments in
sorry, sir.
20,000 shares at cost. So that will cancel out the 20,000 naira ordinary shares in the SCO equity section.
So, Emmanuel, are you saying this investment should cancel out against just this 20? Why are you leaving out the
Okay,
9?
let me see. The 9 is a retained earning, but the source of it is what I don't know. Mm, but basically, I would cancel out the 20,000 from both ends.
Okay, so let's be very clear here so that you won't just be doing guessing game, eh? You understand perfectly. Yakub was right. This one is very straightforward. Receivables against payables, and it's very clear, the same amount. But it might not be the same amount every time. Have that in mind. So if they are not the same amount, we will see the effect of that. And number two, which should even be the first thing you should cancel out in most cases, is this investment with equity, not with ordinary shares. You are canceling out this investment against equity.
Okay.
And when you are canceling out against equity, note that you are canceling out against equity at the date you bought that equity. At the date you bought it, right? Because you know that equity usually evolve. Equity evolves because equity is share capital plus your reserves. Like items like retained earnings now, it evolves. Maybe the day you bought it, the retained earnings might even be zero.
Hmm.
Let's say you are now consolidating at a later date. You cannot cancel out the investment you bought 10 years ago against retained earnings today because that retained earnings wasn't what you paid for. That one has evolved. The guy has made profits afterwards. So we call that
Okay.
post-acquisition retained earnings. So what you are canceling out, why you're right, Emmanuel, that we cancel out this 20 against this 20. The only reason you are right is because this 95 was post-acquisition. This 95 is not related to this 20. This
Hmm.
95 is a post-acquisition retained earnings because we have bought this exco since day one.
Hmm.
The question told us that we acquired ESCO since incorporation. And that means since we acquired him when he just incorporated, his retained earnings will have been zero at that time.
True.
So as of today, having 95, this 95 came up after we acquired him. So it's not the same thing we bought. It's not, so it won't be cancelled out against this. So you're
Okay.
you're learning something fundamental now, that I need you to have in mind. When it comes to canceling out these investments with equity, you are canceling out against equity at the date of acquisition, at the date you bought it, because that's the only similar item. And it makes so much sense that, okay, I paid 20. What am I paying for? This is what I'm paying for, the equity of that subsidiary. So when you want to consolidate, that means we need to know, okay, what did we pay for? What is the equity of that subsidiary at the date we bought it? That is what you cancel it out against. So please note that. If you note that, then you're getting the foundation strong. So, and that's it. Every other one, just add them together. So I'll share you this question just for you to do it and share with me before and you have to do it before Wednesday, because Wednesday we are starting when we have many subsidiaries. Now, if you look at this question, summary of financial position of Pico, he bought a subsidiary ESCO, and ESCO has made his account till August. So, and Pico owned all the ordinary shares, and he also has 40% of the loan stock of ESCO since incorporation. So they gave us statement of financial position of the two of them as this. They also said, they say something as differences in current account arises because of goods in transit. Okay, no problem. So what do we cancel out here now?
Sir, the 40% ordinary share of 1 naira each from the parent and the equity liabilities, ordinary shares of 1 naira, 40,000 of the subsidiary, sir.
Can you repeat that? Sorry.
Okay, I said and inside non-current assets, we have investment in ESCO at cost, 40,000 ordinary shares of 1 naira each, 40,000 naira. So if we now look at under equity and liabilities, ordinary shares of 1 naira for the subsidiary, we have the same 40,000 naira. So that's what I said, sir.
Why are you excluding this 14?
Same issue with the first one. The first one will come.
It's like what you, although, sir, I don't really get the explanation because I'm working around doing other things, but I think I'll watch the video to get it right. But I know from your explanation, the one you made earlier, you mentioned things that I should not, we should not put that also into cognizance, sir.
Okay. So you were listening, Emmanuel. You were not doing something else. So can you explain why we will not cancel out this 14?
Okay. The retained earning, that 14,000 naira is a post-acquisition matter, meaning that as at the time this particular company was incorporated, definitely the retained earning was 0. So we are not going to be canceling that out in this case, per se.
Okay, that's absolutely what I said. That's correct. Because we bought the subsidiary since incorporation. So since we bought it since incorporation, is within earnings as at when we bought it will be 0. So that means this 14 is post incorporation. So it's not the same thing as these shares we acquired. So yeah, Michael is right. We'll cancel out this 40 against only this 40. Okay. Is there any other item here to cancel out aside the investment in ordinary shares?
So 40% from the 12% loan stock will be cancelled out from the subsidiary. But for the parent company, the whole of the loan stock will be cancelled out.
Okay, so what you're saying is that this 10,000 will be cancelled out against this 25,000. So that means here it will remain like 15,000, Abi?
Yes.
That will not be cancelled out. Is that what you're saying?
Yes, that was.
Okay, yeah, that's correct because we only bought 10,000. So you don't need to start doing 40% of this. No, you don't. It's not necessary for loan stock. Just cancel out. Okay, we paid 10 and the guy issued 25,000. So you cancel out this 10 against this 25. Whatever 15 is remaining, that one can be consolidated. Okay. Not only that, let me answer the last one. I can also see something here. The good thing is that, this is introduction. They will always tell you where there are items that to be cancelled out. You will see it is obvious. It will be obvious. Like these two that we have mentioned, it's clear. They told us they are investments in ESCO. This one, they say loan stock in ESCO. So you need to know that you need to cancel out those ones. And additionally, this one also, they told us current account with ESCO, current account with PICO. So when you see current account anywhere in a group account, is used to maintain transactions between the parent and the subsidiary or between members of the group. So that means these guys have had transaction between themselves to the tune of 9,000 and 6,000. But surprisingly, ordinarily we expect the two to be equal on the same side because they should be recording the same amount on both sides, right? So the examiner has actually told us the reasons for the difference. He says the difference on current account arises from good in transit. So, which means that somebody has sent goods, right? but this other party has not received it. So this guy is saying, I've sent goods to you, right? But this one is saying, no, I've only received, I'm only owing you 6,000. I've not received the additional maybe 3. So it is still outside. So when you want to cancel out, so you just cancel out this 6 against this 9. As far as we are concerned, that 3 is not a completed intra-group transaction. It is not completed. So we cannot cancel that out because this other party says, I have not received it. So 6 will cancel out against 9. The remaining 3, the question has told us that treat it as goods in transit. So you consolidate and call it goods in transit. So we have cancelled out. So what is remaining is just to add them together. So you add these two together. This one has been cancelled out. This one has been cancelled out. You add these two together in the consolidated account. You add these two together. This one, it has been cancelled out, but remaining 3, you call that goods in transit. You add these two together. You cannot add these two together because this 40,000 has been cancelled out. You add these two together. You consolidate this. This one, we have cancelled out 10 out of it. So you only consolidate 15. You add these two together. You add these two together. This one has been cancelled out. Very straightforward. What's time? Okay, still have like 10 minutes. Now, for this one, here now, look at it. We acquired only 75%. In those other questions we have been solving, we acquired 100%. So, of the share capital since the date of incorporation. And yeah. So, looking at these statements, the only thing we can cancel out as at the date of consolidation is just this 15,000 against the equity of the subsidiary. But this one needs some workings. Even without workings, I can know that, okay, I want to cancel out this 15. And I know that this 15 represents 75%. So I will just only cancel out 75% of this, right? I'll cancel out 25% of this. So the remaining 25%, you can guess, it belongs to people we call non-controlling interest. So that one will be consolidated. So we only cancel out 15 against, but let me just show you how that is cancelled out. So the way that cancellation works, yeah. So the consideration transferred, he paid how much? He paid 15. Paid 15,000. He paid it for share capital. How much was the share capital? It's 20,000, Abi?
Yeah, 20,000.
Yeah, 20,000. So remaining how much?
5,000.
What do we call this 5,000?
Non-controlling.
NCI.
Non-controlling interest. 5,000. Now, don't forget that ordinarily, this 5,000, the reason I'm not canceling it out is because it is post. I acquired the subsidiary since incorporation. So this 5,000 will be consolidated. To be consolidated. So, but this is a very good way of doing it. And there is a structured way that you need to learn because that's how I'm going to be treating it from next week. The structured way is this, even though it's still giving the same answer, but that one is better when things get complex. So the way we do that one, the way that operates, is that, okay, we are saying this is 75%. Okay, let's get the balance, which is non-controlling interest, so that let's get the balance. So usually we would hold on with the balance and say, okay, what did we buy? We bought just the share capital. So when we know that, we'll know, okay, that means the balance, since we bought 75%, the balance is just 25% times 20,000, which is how much? 5,000. So that gives me 20,000. So so that means this 20,000 can then easily cancel out this. So we'll now make this like a workings one. In addition to that, we'll now have a separate workings called non-controlling interest. We'll still come and bring it, we'll say, because this non-controlling interest is usually consolidated, because to a large extent, it's not like a similar transaction, but we structure the cancel out like, okay, let these ones cancel out. So that we are comparing 100% with 100%. Fine. So this NCI, let's treat them separately for a lot of reasons you are going to see very soon, because NCI, they are powerful people, they are like owners of the company, they get share of profit and all of that. So we separate it just so that those further adjustments can then be made later on. So it's almost the same like the first I did, but now I've separated this value of NCI was just something I picked from here. It's not anything out of the ordinary. I just picked it from here and said, okay, this is the value of my NCI. Now, additionally, is that you now find out that this NCI will not also have share of retained earnings, because these retained earnings of the subsidiary of 5,000, it belongs to the shareholders of the subsidiary. It belongs to the shareholders. So, and now that we only have 75%, the remaining 25% belongs to these guys called NCI. So, which is, I think 1,000, no? That's 1,250. That's divided by 4. So, that brings me to a total of 6,250. So, in fact, that means and I can then do a workings for consolidated retained earnings that will consolidate. I will consolidate that of the parents when I get to this 12.5 of the parents, and I'll consolidate my share in the subsidiary, my share in ESCO, which is 75% times 5,000, which is 3,750. So if I add these two together, what will it come to? That should be around 16,250. Am I correct? Yeah. So the way this work, consolidated statement of financial position, I just want to use this statement of financial position as at year ended 31st December. 31st December, is it December? Yeah, 2017. So first is this PP. I will add it together. What's 25 plus 17.5? That should be 32,500, if I'm correct. $32,500. These investments, this 15,000 has been cancelled out. The next is current asset. Can somebody help me add 22,500 plus 17.5? 22,500 plus 17.5. 62,500 plus 75. That's 40,000.
Yeah, 40,000.
Yes, sir,
Okay,
correct. 40,000, sir.
thank you. Then now I can have my total assets. What's the addition of the total assets?
72,500.
Okay. Then I can have my equity and liabilities. My equity starts with my ordinary share capital. So what's my ordinary share capital that we consolidate? This 40,000, because this 20,000 has been cancelled out. Don't forget. But not everything, only 15,000 has been cancelled out. But the remaining 5,000, I gave it a new name. What name did I call it?
Non-controlling interest.
Non-controlling interest. So that means my ordinary share capital is just how much? It's just 40,000. It's just 40,000. I'll still bring the NCI. Let me just be done with my consolidated retained earnings that I worked up here. This 16,250. I just did the workings. Ordinarily, even without the workings, I can just come here. My retained earnings is my 12,500 plus the parent share. Since the parent does not have 100%, so he only has 75%. So, and I've worked it here already. So he's having 16,250. Then I can then bring in that NCI because that's the part of the subsidiaries equity that is owned by outsiders. That's the NCI. We worked it up here as 6,250. 6,250. Okay, that's all for equity. So can you add these three together? What does it give us? That's 56,250 plus 6,250. That's
62,500.
62,500. Then I have my current liabilities. Current liabilities. And how much is my current liabilities? How much is my current liabilities? 20,000, which is the parent and the subsidiary. 20,000. Then I have my total equity and liabilities to be 82,500, which should be equal to this. The only reason why it's not equal is because you people, I don't know whether you are not participating, because that means we did not add something together very well. Let me add these two again. When I was asking figure, nobody's saying anything. I will just give you a wrong figure. You go away with a wrong solution. What's 25 plus 17,500? Sorry?
42,500. 42,500.
42,500. All right, so this gives 82,500. So now, see, nothing has changed. It's still cancellation, just that we're just trying to structure something. Even without these workings, I can still consolidate because it's still very straightforward. So this guy bought only 75%. Immediately I know that, okay, the remaining 25% is called NCI. So when I'm canceling, I can only cancel against 75% of this, but we say let's structure our workings in such a way that let's know, okay, if we paid 15, the remaining 5, somebody has paid for it. Okay, let's consider them. Let's cancel it out against the equity of the subsidiary. In this case, it was only share capital that was there when we bought it because the retained earnings as at that date was 0. Whatever retained earnings you are seeing here was after acquisition because we bought the subsidiary since acquisition, since incorporation. So when I now did that, I now brought out this NCI that I did not cancel out because I can't cancel it out. It wasn't similar transaction, right? I'm only doing this just to accommodate some complexity later. So I got, okay, the value that I did not cancel out, 5, and I acknowledge the fact that this NCI are also owners of the subsidiary. They'll also get a share of that subsidiary. So they get a 25% share of its profits. And also, then I did the remaining retained earnings. Yes, I consolidated my own. Then I took my share in the subsidiary. Then I consolidated all that. Yeah, and you can see that this NCI, which is the balance of the share capital in fact, the balance of the equity of the subsidiary is coming under equity here, which makes sense because it's the balance of the equity of the subsidiary that is not owned by us, but by other people. We call them NCI, we put them under equity, so they should be under equity as well. Okay, so that's it for cancellation. You can check the same knowledge you have. You can try your hands on these other ones. I have a lot of questions for revisions before we move to complex group where you have more than one subsidiary. These are our own focus. So all this I'm doing is just introduction. Our focus is this for this class. But I just want to remind you about cancellation, intra-group transactions, all of that, then so that we can jump into this. So you can just look through these other ones and see if you can try your hands on it. Next week, I will use another maybe 30 minutes or so to still do some further revisions for you again before we go into that aspect. Okay, so we're going to stop here for tonight. Yeah, or for today. Then we're going to continue on Wednesday. So try your best as you can. If you can revise it, it will help you. Thank you very much.
Thank you, sir.
You're welcome.
Thank you.
You're welcome.